Hey guys, it's Justin here from Better Wealth, and I'm excited for what I have for you all today because you get to look a little bit into what I actually get to do every day. Had some people bring some policies to me. They wanted to have them reviewed, really just to see if what they had is what's best for them or if there potentially could be a better option out there for them. So I was able to take those policies, review them, give them my feedback, and then actually we ended up looking at a couple of different options for them and ended up deciding to move forward with something else that was able to give them some more flexibility, more cash value, more death benefit later on, and really just improve it all around, which is always something that I enjoy getting to do. Now, does every policy end up where we are able to do a 1035 or we have a better option? No, not all the time, but whenever there is some, we are able to help people out. That's always a great thing. So that's what we're going to do today. Dive into a couple of illustrations here, and we're going to start with person number one who came to us really looking at what they had was they wanted a policy. They had a New York Life policy, and they had originally got this policy, had it for not even a year, but almost a year. And we're coming up on year number 2 for the renewal as they paid monthly. And they had this policy because they wanted it for something long term. They weren't looking to really pull out any cash value in the short term, really had the policy so that they could have a supplemental retirement income, have some cash value available to help with that, and wanted that permanent death benefit so that they could have that for their whole life rather than something like term to help in the short term there. They wanted that permanent death benefit to be able to leave to their beneficiaries when they did go. So what we actually ended up and we were able to do was this person, we did a 1035. So we're able to do a 1035, which, as you know, if you've been watching, this is where we take their current cash value. So whatever cash value they currently have, we're able to roll that over into a new policy. And then we start that policy from there. Now, there is a loss there. So if you've paid in $12,000 and you only have $2,000 of cash value, well, then you lost $10,000 because you surrendered that policy. Yes, we can start a new policy, but you're only able to roll over that $2,000 or whatever it may be amount there. So that's what we did in this term. And actually, we ended up still being able to have a lot more cash value with that loss in year 2 of what their old policy, year 1 of their new policy, which was a pretty cool thing to be able to do, as well as the long-term benefits there. So yeah, this person, again, wanted this for long-term. So I will share this here and we can take a look. Yeah, so here is this person's original policy that they had. So you'll see year 1, this policy, when I got sent the illustration, still showed that they were in year 1. They had actually ended up paying everything and we're coming up on year 2. So they had a little more cash value than this, had actually paid that full amount there. But I'm going to skip to year 2 because that's really what we're going to be comparing it to, is when they do start a new policy here. So year 2, they would have put in $12,000 for that year, and they had already put in $12,000 for a total amount of $24,000 going in over 2 years. And you'll see here their cash surrender value, $6,868. If you watch this channel and seen any illustrations we've done, you know that's a very low amount of cash value for the actual amount that they have put in. Now, again, they didn't get this policy for the cash value and they weren't looking to borrow against it anytime soon, is that's really not something that they thought they would be able to do. They stumbled across us. They were really looking at, is this policy what I want? Found Better Wealth on YouTube or the And Asset channel, and we're able to look and see, oh, you can get both, where you can have lots of cash value early on and still be able to use it in retirement and have that death benefit. So they were intrigued by that. Not that they had a great need for it, but they liked the idea of, I'd like to have a lot of cash value available. So let's look at something potentially different there. So you can see here, paid $12,000 and then it dropped. There was a term rider on there for a little bit, dropped to that $11,792. They were only going to fund this all the way through age 60, and we start off with a $605,000 death benefit, and we end with a $635,000 death benefit. So by all means, really more of a true whole life, there is a little bit of the paid up additions. So you do have a little bit of cash value, but generally, um, yes, it's still going to give them some benefits long term, but we wanted to see if there was something better. So what we did actually in one of the a lot of times a good place to go where if we are looking at what we call like a cash flow policy where we're just doing the same amount every year at that $12,000 mark. And so we came over here and looked at something at Penn Mutual. So let me walk through what's actually going on here. And you see first year premium here. So we'll look at this premium amount going in year one is this 14,149. So remember with the 1035, we were able to start with that extra cash value from the old policy. So what we did was we took that amount there. It ended up actually being a little bit higher than what this was, but I wanted to illustrate with what was shown. They did have some actually more cash value, but got $14,149 in and had about $11,655 of cash value. So you see there, we've put in that 14,000. They've put in 12,000 on their own. So total, we've put in that $24,000 of premium out of pocket, and they're able to get 11,655, which again, still not great. We have to factor in that we did lose out on all of what they had already paid in the other policy. However, we are quickly able to make that up and get a lot more cash value available. And it's a matter of once you did start something like that, you're going to have that loss. You can keep paying into that policy, and eventually you'll get to that break-even point where you have more cash value available than what you've actually put in. It's just going to take a lot longer if you continue funding a policy like that, where it's mostly based. Again, that one actually had a little over a $9,000 per year minimum amount that they had to pay. And so they were paying about $3,000 or so of paid up additions. With this one, our minimum amount that we actually have to pay is $2,400. So we're paying almost $10,000 of paid up additions every year. So one, what that does, it's going to give us that cash value. But the biggest thing is it's going to also give us that flexibility where if we don't want to pay $9,000 every year, we can drop that down and have the ability to move that up and down there. So year one, 11,000. A little over $11,000 of cash value compared to what we would have had at the other policy of just $6,000 even after paying $24,000. So already very big improvement there, and then just continues to get better and better every single year from there. And you see here also that we do reach that point where we have more cash value available in year 6. So typically that's going to be anywhere from, could be year 5, could be year 7, somewhere in there is typically where that we can make that happen. With the other policy, we would have had to continue funding that, and it would have ended up being somewhere in year 10 plus or so. So still make up for the loss of losing out on the $10,000 early on in that policy, but can make it up here. The one thing that this policy does not have early on is a higher death benefit. So remember, whenever we are most of the time in general maximizing the cash value, so we're going to maximize the cash value, we have to lower that death benefit because we're not buying a lot of death benefit early on. We're buying as much as what we need to so that we can get as much cash value in the policy as what we can. Now, you'll notice the other policy, it grew from $605 to $635,000 of death benefit, where this one we start off at $296, and by the time we get down here to year 15, we're already at $723. So the pure whole life, which that one wasn't pure whole life, but was mostly whole life, had a set death benefit. It will grow slightly, but not very much. High cash value, it's going to start lower, but it's going to grow quite a bit there. So now to look at a quick comparison, so putting them side by side, I know we had lots of numbers there. It's starting off in year 1/2, because we would really be looking at a comparison of where would you be in year 2 if you kept funding this policy, where would you be if you started a new policy here at Penn Mutual and working with us. So we would have had $6,868 of cash value. With our design, we would have had $11,655, and so that's a $4,787 dollar difference or a 69% improvement. So we can look at the percentages, because think if this was a $120,000 policy versus a 12,000, a 69% improvement there would have been a whole lot bigger of a dollar difference there. And then where it really starts to get bigger and bigger percentage wise, it drops some because that other policy, again, your basic whole life, it will eventually build cash value. It's what any permanent policy will do. It's just going to take a lot longer to get there. You're not going to have as much flexibility, and still it's not perhaps going to build as much there. So that gap does get a little bit closer, but all along the way, you've had a higher amount there. So by the time we get to year 20, we would have had $325,000 of cash value. Here we could have $396,000 of cash value. So a $70,000 difference. And that's when they would be getting to the point where they may actually be starting to utilize some of that. If they wanted to use it as a retirement supplement, be able to have some extra cash value available as well. Now, this was just one policy. They had some other policies and different things, but they were just looking at this one. That can be, you see the big advantage there. Now, the one negative, like we said, is if we are looking at a whole life policy for cash value, it's not going to be a policy that's going to give you a high death benefit early on. So it's not going to be enough to cover your human life value. A lot of times we recommend supplementing it with something else, whether that's a convertible term policy or if you have something through work, needing to have some extra coverage, because in the short term, you will not have as high of a death benefit. It will take time to build up, and ideally, when you truly need that death benefit, it'll be much higher. It will be permanent, so you make sure that it does get paid out. However, in the short term, for protection, or if something tragic happens, you see here, it is actually quite a bit lower. It's half of what it was in year 1/2, and then by year 5, we're catching up, and by year 20, we actually are quite a bit ahead. So over time, it's gonna really take off and be quite a bit ahead. But in the short term, it's not going to. Now, this person, they had other coverage. They had some coverage through work. They had a couple of other policies as well. So they had some extra coverage, which was a good thing, and why something like this still made sense for them. But if we were really focused on that death benefit, maybe a little bit hesitant to do something like this, or would recommend maybe doing slightly less, do $11,000 a year, put $1,000 towards maybe a 30-year term to make sure that you cover that difference. A lot of different things that you could do there, but just want to point out that death benefit lower. So what we were able to do there is really save this person, give them flexibility, 2,400 versus 9,000 of being on the hook to have to pay, give you lots of cash value early on, as well as better long term. So that was a fun one, able to do that. And you can see it's that $12,000 a year mark. If you are bigger, it could be $120,000 a year. The percentages, a lot of the things will be the same in what you're looking at there.
Hey guys, I just wanted to interrupt real quick. If you're watching this and have an index universal life policy, a whole life policy, have any type of insurance policy in general, and you're like, I want to know if I'm on the right track. I want to know if this is set up properly. We at Better Wealth want to help you. We want to give you a free policy analysis and show you, are you on the right track? Is there some things that you potentially could be doing better? And so we have a link down below that you will have access to. We would encourage you, if you have a policy and you want to see if you're on the right track, check that out. And if you're someone that's watching this and you're like, I want to talk to someone and maybe setting up a policy for myself, or I have questions, we would love to serve you. You can also see a link to have a call with someone on our team. Back to the episode.
So now moving on to policy number 2 and what we had going on here. So this person, this is going to be a little bit bigger of a policy, and they came to us with a policy that they hadn't gotten yet. So they were working with this person. It was actually at Security Mutual was the company, and they hadn't gotten the policy yet. And they just wanted to have a review, see if there was anything better out there. They were going through the process, but before committing, wanted to make sure that since they're going to get a permanent policy, going to be around for your whole life, is this what's truly going to be the best for me and the goals that I have? So like I said, this policy was at Security Mutual, which you'll see here. I actually don't have the illustration. They didn't have that, but they had a spreadsheet, which I copied it and had a funding strategy there. So it was just the numbers from the illustration pulled over, but they didn't send me the actual illustration here. But we can look at that and see what the numbers are. And you'll see Security Mutual, I've actually looked at quite a few of their policies, and it's not bad at all. You're going to have some cash value. you're going to have growth, you're going to have flexibility and a fairly low minimum, but it's not great. Typically, in nearly every case that I've looked at them, there's been a little bit better option of somewhere else we could go. But again, it's a definitely not a bad policy, but this person didn't want something that was just okay. They wanted something, hey, what's going to be the best for me? And so that's what we were able to actually do is he really wanted, just to lay out the details here, he wanted ideally his minimum to stay somewhere around $5,000 to $6,000. He wanted to be able to put $50,000 in. That's what he had originally planned. That's what we're going to look at. And he actually said, ideally, he'd like to put in $100,000 if he could, but due to a lot of the constraints, if he put $100,000 in, it's going to up his minimum. As most of you know, if you've watched there, the bigger the amount that you start with, we have to buy enough death benefit to justify us putting in that amount of money. So if we do a lot, do a front load, our minimum is going to be raised and it's going to stay raised for that entirety of the policy in most cases. So he thought he wanted to do that, would like to do that, but it was at least a security mutual not going to be able to. So what we'll do first is we'll look at what if we just did $50,000 each year, do a comparison, because yes, cash value, if you put in 100,000 year one versus 50,000, doesn't matter what the comparison is, you're probably going to have a whole lot more cash value with 100,000. So we'll look at a true comparison and then also look at what he ended up really wanting to do and get that $100,000 load and be able to get all that money in, because he was just sitting on the cash. He had it and would rather put it in the policy that he was going to get anyways so that he could get it compounding and growing. So what I'll share here first is this policy. So again, this is not the actual illustration here. They had a spreadsheet. It was different. It had the company they were with and everything. It had a funding strategy here, but pulled this here. And you see here the premium, $52,000. They were going to put in 50. The maximum was 52. And the cash value that they would have is 43,000. So pretty good cash value. Put in 52, have 43%. That's a good amount there. You're looking at about 80, a little over 80% of what you put in, which is good. And then a very high death benefit, 1.5 billion. That's going to, you see here, continue to grow along the way. So 52,000 in. If you look, it continues to grow. Now, the problem here, and one thing that he also didn't necessarily like about this, is that this had a term rider on here that was a 7-year term rider, and we were actually only able to put in that amount. And you see it drop here, and then we drop to the minimum. So he was only going to be able to fund the amount he wanted to for about 6 years, and then it was going to be a little less, and then he would only be able to fund the minimum ongoing in the policy. So he wanted to be able to fund for a long time, or at least have the option to. So he's only going to be 45 here. He likes to continue funding till at least maybe 55, maybe even longer, but he would only have the ability to do that for a short time in this policy. So a lot of times you'll see that, hey, we only want to maximize the early cash value. Sometimes that can limit you by the actual amount you're able to fund and end up hurting you if you're able to keep on putting money in. That policy is going to continue to grow. A lot of people say, hey, you can just start a new policy. True, but if we're at year 7 of a policy, wouldn't we rather keep funding the policy that's already fully capitalized, already had that break-even point, rather than starting over? Generally, the answer is let's keep funding what we already have built rather than starting something new. So a lot of times we want to make sure and be able to have that, at least have the option, unless there's something where you truly are, I only want to fund for this long, and then I'm going to stop. That's one thing he didn't like that he had mentioned to me. So wanted to make sure and give him the ability to fund for a long time there. So that's what he started with, what we were looking at. And then here's what we actually ended up not going with, but what we looked at here. If we just did the same amount every year, that $50,000, I know the other one's 52,000, but if you look, we put in $2,000 less, and guess what? We have a little bit more cash value still. So this policy is at Guardian. The reason we wanted to go with Guardian here is because we can keep that minimum very low. And with the way that they can have their term rider on, which is just a 1-year renewable term, and that's the term rider, so that it's able to, we can put in quite a bit of money, bump up that death benefit, and especially what you'll see, be able to get a big front load in year 1 a lot more and then still drop down to the amount that he wanted. Keeping his minimum low is what we would be able to do at Guardian. Perhaps if we did $50,000 a year somewhere else, we might have a little bit better performance long term, but we're not going to be able to one, put in 100,000 in year one, keep our minimum extremely low, and have that range of flexibility like we would at Guardian. So for what he wanted and his goals, this was going to be the best place to go for him. And so you see here, like I said, put in $2,000 less, still have more cash value. And in year two, we had put in the other one about $104,000 and only had $89,000 of cash value. Here we're going to have about $95,000 of cash value. So quite a bit higher there. As in just year two, we've gained 6,000, and it's only going to continue to grow and get better as you go there. So you'll also see here our actual break even point. So I know a lot of people like to look at that. Ultimately, that point only really matters if you're planning to surrender your policy and don't want to lose money. But year four, hey, we have 200,000. We have our cash value at 202,000, and that was something to point out because that was important to him. And it just continues to grow every year after that. You'll notice here, if you've done and looked at the reviews, if you haven't, I know there's a video down here explaining the term riders, diving into a lot more detail about why is this death benefit level. Has to do with a specific term rider we'd use at Guardian. And then you see here, eventually it grows there. So this one, he wanted to be able to fund for 10 years. As we talked, he didn't want to fund for a long time, but he said at least 10 years. Get him almost to 50s when he would want to be able to do that. If he had wanted to be able to fund for longer, we would have made that. And we talked about that, the pros and cons of stopping. But due to what he was doing, due to his work and what he had going on in life and in the future, he was pretty certain that he would not want to be able to do that and then be able to still, hey, we can fund just the minimum if we want, and you're still going to have lots of growth in the policy here. As you see, jumping from 625, it goes up nearly $40,000, and we only funded with 9,000. So got a lot in early, which is great. A lot of what we do at Guardian is, hey, we're going to fund a lot early on, short-term funding, and then you can see it continues to grow from there. So to look at a quick comparison, similar to before, going to pull up this and take a look here. So old policy, the Security Mutual policy, $43,000 of cash value. Our design here, we were able to get slightly more, but again, the other policy had about $52,000 going in year one. Ours had 50, so we could have had it higher if we funded at the same amount, but he only wanted to do 50. The other one just had a maximum of showing what that was. So slight difference there. And then you see here the pretty crazy part, and part of it has to do with his funding because he did put a lot more money into this one. The other one, remember, he could only fund 50,000 for 6 years, and in this one he was actually able to fund 60,000 or 50,000 for 10 years. So that's where a lot of the difference comes. So that's where the majority of, hey, we have 49,000 or 49% difference, but that's what he wanted to do. The other policy, he was not able to do that. So he's going to fund it that amount, and you see the growth here and what that looks like. And then the death benefit, pretty simple here. It's going to be level early on. That one's growing, and then after that, it does continue to grow so that by the time he hits year 20, he has about nearly $300,000 more of death benefit, which is going to be important to him, important to be able to leave a legacy, leave something for the kids there in that sense. So we see there a lot of that wasn't necessarily, yes, the policy, the design, everything, we're able to get it a little bit better, a little bit more efficient, but two, based on his goals, he wanted to be able to fund for at least 10 years. The other policy was not able to do that. So we can look at and design the best cash value early on. But if somebody wants to fund for longer, then that's not going to be the policy for them. You can sacrifice a little bit of early on cash value, have better performance long term. And that's where working with us at Better Wealth, we strive to figure out what do you want and why do you want it. And then based on that, with our expertise, we can find the best option for you, whether it's at any of the many companies that we work with. But getting a clear understanding of your goals is important rather than just, hey, here's the best product. So we don't know the best product for you without knowing the actual goals of what you have in mind and what you are wanting to do with the policy there. So to show you finally what he actually ended up going with. Because remember, he wanted to be able to get in $100,000 that first year. So what we did here was at Guardian, big thing why we liked it, we're able to get quite a bit in that first year without changing too much. So we had to bump up the death benefit. So he's going to have a higher death benefit. He's able to put in $100,000 into the policy and have over 90% liquidity available in the first year. And that was huge for him. He wanted to add, he has a business, has some investment ideas, things that he wants to do, that he'll have that liquidity available to him so that he can do what he wants there. And then after that, continue funding at that 50,000. Since we bumped up the death benefit, a couple things going on here. He could even fund for a little longer to 50 if he wanted to. And that was the ideal amount. He said, not probably going to ever fund more than that after 50, but would be good to have the ability to go all the way to 50 if I could. So that's what we settled on right there, designed it where he could do that. If he did fund at 50,000, his death benefit then never drops, continues to grow, and he has a great policy specifically for what he is wanting. And one, the biggest thing, put in a lot of money up front, be able to fund for at least a short time, 10 or so years, and then still keep that minimum low, because he was thinking, worst case, what if I can't fund this thing? I want to make sure that I can at least keep the policy in force there. So that's always a big thing, and why we like the flexibility of these high cash value products, where most of it, yes, the PUA, everything's going to give you cash value, but it also gives you the flexibility and gives you options, which is something that we love, what we love to talk about here at Better Wealth. So all in all, able to take those two policies, take one that was not great really at all for cash value and what they ultimately wanted, and make a big improvement, and then take one that was just an okay policy and show you what is best, because there's options out there, lots of different things, but a lot of it is based on your goals. So say if you do have questions about this, you have a policy that you'd like reviewed, whether you've had it for a few years or you're just looking at it with somebody else and want to get a second opinion on that, feel free to send those over to us. We're glad to take a look, review the policy. Hopefully we say, yeah, this is great, keep what you have, and keep funding it. But if not, we can tell you, hey, here's what you could do. Here's how it could potentially be better. Show you the options, and if that's what you want to do, just like these people, you can see the difference that it can make. So I encourage you, schedule a call, send us your policies. We'll be glad to take a look. And that's what we do every day. Really enjoy it, really looking at the numbers. And the main thing, just how can we improve people's lives, take their old policy, give them something better for the exact same dollars that they would have been putting in already. So just make it a little bit more efficient for what they want. So I'd say enjoyed it. Y'all have a good day.